Thank you. So thank you everybody for joining. And so my name is Jasper Crawley. I've just moved out to Singapore during this pandemic. Got here 2 weeks ago. Did my stay-at-home notice with all my family in the Orchard Hotel, all stuck in a room with 3 children and my wife as well. So it's nice to be out and about, and really nice to be able to speak to you all today. What I thought we'd do is briefly touch on who the World Gold Council is for those who don't know us, and then kind of remind everybody what it is about gold that's interesting. And we can do that through the strategic case for gold. Then I'll give you a market outlook and an update on what's been going on and what we're watching. And then finally, I wanted to bring everyone's attention to some resources that might be useful for you when you're looking at gold. So down there, just to draw your attention to myself, bottom left, Estelle joined the team recently as well, and so you can always reach out to either of us if you do have any queries or questions on gold. So briefly, the World Gold Council is a membership organization. Our members are gold miners, so we work on their behalf. The reason why what we do on their behalf is really that they realize they spend a lot of time promoting themselves as investments, and they compete with each other to produce gold at the best possible price. They realize that they didn't really spend a lot of time talking about the underlying product that they make or create or dig out, and they realize that it is identical. They all produce exactly the same thing. So it would be in their interest if somebody perhaps would do that for them. So that's the role of the World Gold Council. We do a lot of different things. There's a lot on this slide, but if I just draw attention to the bottom, the circles on the bottom left, look, Estelle and I work in a team to help get data out to the market. Data is really important because investors recognize that if they don't have sufficient data, they can't make an investment. So we help produce a lot of that data. Analytics, and I'll show you some later on our website. Research is there. It's available for everybody, and I can show you again on the website. And then market knowledge. So that's what I'm doing with you today, is sharing some market knowledge with you. Then finally, there is other teams in the organization that do things like work on policy and infrastructure. It's not what Estelle and I do, but it is quite interesting. For example, they're working with Russia at the moment to have VAT removed on gold, in the hope that might increase a bit of gold demand in that region. On infrastructure, we're working with the Indian government to help create a spot exchange and a bullion banking system in India. So it's kind of some of the other things that we do in the organization. So I thought it would just be useful just to review a case for gold, just briefly understand kind of what it is about gold that makes gold an interesting investment. And so the first thing that we look at is the returns that gold produces. And I often get this kind of objection around gold that it doesn't have an income stream. And because it doesn't have an income stream, it doesn't produce any return. So what we've got here is a chart that has a lot of things that investors will hold in their pension and hold in their portfolios, and then gold's returns alongside them. So you can see the last 10 years have been okay for gold. You can see, I think it's US stocks, that really have outperformed in the last 10 years. You can see commodities. If you decide to hold, say, a commodity index instead of holding gold, you can see you'd have been significantly worse off. If you look at gold or a 20 or a 20-year basis, perform very well. But if you go kind of long-term returns, you can see that gold's returns are not that different to the other things that investors hold in a portfolio. And so we think it's one of those assets that therefore should be held alongside them strategically. When we look at how gold behaves, I think this kind of chart, this slide is quite interesting. This is gold's correlation to the S&P as a proxy for growth. Let's call it the S&P proxy for the market in different market conditions. So gold is the gold bar, and the red is actually commodities. So you can see that in a good week for the global economy, when the S&P is up by more than 2 standard deviations, what's interesting about gold, and quite often unexpected, we hear from investors, is that gold's correlation to the market is positive. So gold has a link to economic growth, and that'll come through jewelry demand, or come through technology demand. That makes up around over 40% of gold demand, basically. So there is that link there. Now, when the S&P hasn't done a lot, so within plus or minus 2 standard deviations, gold's correlation is basically zero with the market. But then where gold, really comes in, and this is why gold is well known, is that when the market is down by more than 2 standard deviations in a week, so you imagine GDP contracting, poor PMI data, on a week like that, gold's correlation then flips to negative. So the market is dropping, and you can see less consumption, so oil and copper and things like that remain positively correlated to the market and drop with it. And that's where gold comes into its own, and that correlation flips to negative, and gold will have a good week in that environment. So, it's unusual to find an asset that can do that. So we like to point that out. Liquidity, I just do get this objection quite often that gold is illiquid, and so we thought we'd dig into the data and just demonstrate whether it is or it isn't. And this often, catches European investors out, because you can see that gold, if you add up, what we have here is OTC transactions in London, the futures transactions on the COMEX, and then ETF flows. And if you add up those on a daily basis, you can see that the kind of notional value is actually greater than what's traded in euro sterling on an average day. So, the idea that that you can't convert gold quickly and easily into cash is just false, in my opinion. So this demonstrates that. And the other part, thinking it back to other things you hold in a portfolio is certainly in Asia, I've seen a lot of investors like to hold real estate. And real estate is something that gives you, good returns over the long term. The difference really with gold is that it's difficult to get out of real estate when you need to and when you want to. And so to have something again in your portfolio that you can convert to dollars easily, quickly, is very useful. Finally, we get asked a lot, right, how much gold should I own? So this, this graph shows you, we took a standard US pension portfolio, diversified portfolio, from the consultants Willis Towers Watson, and then we added gold to it. Can you mute your line, everyone, because I can hear a bit of feedback there. You can, yes, so we muted, sorry, I can still hear, Javette, I think maybe can you mute your line? Yeah, perfect. So we added gold to this portfolio, and you can see that your risk-adjusted returns improve the more gold you add, but to a limit. It looks on this particular basis around 5% is a good amount of gold to hold, but it really does depend what you own. So the more equities, the more risky assets you own, the more gold you want to own. If you've got a portfolio that's purely bonds, fixed income, you can afford to own less gold with a portfolio like that. So it is individual to what you own. Right, so let's go on to market update and what's been going on. So you'll all recognise this in August. Gold hit a new all-time high. Interestingly, when you look at gold on an inflation-adjusted basis, I think we see the all-time high around 2,700. So potentially more room to go. But it's hit an all-time high. There's been weak consumer demand, strong investment demand. Central banks have slowed their purchases, and I'll show you what the supply looks like as well and how that's been affected by coronavirus. So again, you'll probably be familiar with this chart. Probably draw your attention to March. In March, we were taking a lot of calls from concerned investors who owned gold as part of their diversified portfolio, and were concerned that it wasn't really doing its job, and they could see everything dropping in their portfolio, and they were trying to understand why gold did as well. So it's worth touching on that. What we saw in March was a lot of leveraged investors getting out of everything, and at that time gold wasn't going to be untouched. There are a lot of leveraged investors within gold too. So gold did go through a correction during that period, but you can see that it came back very strong. Interesting at the moment, you can see the moving averages all fanned out, which indicates a pretty strong trend for gold at the moment. And then, lastly, I guess since the peak in August, going through a correction phase. My chief market strategist always reminds me that corrections in gold tend to last weeks, not days. So that it could go on for I would guess a few more weeks from where we are. So gold and other currencies. This chart I find it probably doesn't get enough attention that it deserves, particularly if you go right back to kind of 2008. You'll know that gold peaked out previously, and people talk about it in dollar terms around 1900 in 2011. What was interesting about that time was that the dollar was really weak, and so when we started to see the signs of another bull market in gold, you could see gold lifting off in other currencies, but not in dollar. The dollar is still pretty strong. It's about 27% stronger than it was in 2011, and yet, despite that strength, it's very interesting to see gold performing so well. But it is interesting. We did feel like it was a bit of an indicator to see gold start to perform well in euros and in sterling ahead of perhaps a pickup in the dollar price. Jewelry demand, which I touched on earlier. Sorry, I've got to move that over here. So jewelry demand. So jewelry and a lot of the physical market made up prior to this year. I think they averaged, if you count technology, jewelry, and bar and coin demand, it was around 80% of over the last 10 years, around 80% of gold demand. So there's been a big drop in jewelry demand this year. We've obviously had a lockdown in India, which makes up roughly 20% of physical demand. And that has prevented people from obviously purchasing gold. Obviously, there's been loss of income as well. And I mean, interestingly, actually, on the other side, perhaps selling has been prevented too, because people haven't been able to get down and start that recycling process of selling out their old gold and converting it to cash. But you can see that on the first half basis, versus other years, and if you relate this back to, say, 2007-8, you remember how bad things were in those years, you can see that jewelry demand really has fallen dropped considerably. I picked out this chart because I thought it was interesting to see. A lot of you will come from, I think a lot of you are from Malaysia today, so you can see kind of where Malaysian physical demand has dropped versus others. But you can see sort of, Hong Kong, big drop, China and India, which make up between them perhaps 40% of physical demand, big drops in those regions. So with that in mind, why would gold still have performed so well? And so the big feature of the market this year has been ETF demand. We cover this pretty well on our website, and I can point you in that direction later on in this call. But you can see that the tonnage, I think, is about over 700 tons of gold going into ETFs this year alone. We've seen in terms of Q1, I think it was a sort of 600% lift off versus the year before. So it's a big pickup. 40% of gold demand, sorry, 40% of gold supply this year has gone into, or equivalent, has gone into ETFs. So this is the Western investor. This is the kind of fear driving the gold price, and perhaps you can think one way to think about gold perhaps is the jewelry demand and the physical demand being a kind of base price for gold, and then this investor demand comes in and really picks gold up and removes it away from a physical price. So this has been the big driver. COMEX is interesting because we used to use COMEX as for positioning. Basically, you can look at net managed money positions on COMEX as a proxy for how long or short is the market, and that worked pretty well. So you can see on the chart on the right, when you've got a net short, for example, just after June 18 on this chart, there's not a bad time to enter the market if you think speculators have gone too short. And then likewise, when you see this peak, that can be an indicator that the market's a bit long and you've got a lot of hot money in there. What happened with COMEX was we saw a disconnect in the price around April, where people that were long futures in New York and expecting to be exposed to the gold price through those futures found that the futures started to detach away from the gold price and trade differently. And because of that, a lot of the length that would have been in the COMEX market has moved into the ETF market. There was a preference from those investors for a physically backed product that would therefore give them exposure to the gold price without other concerns basically around gold. So that has meant that it's been a bit harder to judge length in the market with these investors not there. Over the last decade or so, and you can see that actually, in 2020, despite a higher gold price, central bank purchases, have been pretty decent. We expected them to slow down in 2019. We got that wrong. I suppose it was a nice surprise. The purchases picked up further. So this year again, we were expecting a slowdown, and it appears that has come to an extent, but it's by no means been a bad year for central bank purchases. Production. Gold production this first half of this year was down around 5% versus the first half of the year before. And a lot of that is related to coronavirus. As you might expect, various mines had to halt production. Production was affected. What's interesting about gold production for me is this concept of peak gold, which is the idea that can miners keep producing and increasing the supply of gold. And so prior to coronavirus in 2019, we saw gold production down 1%. And so there are question marks about whether we've seen peak gold production now. This year, obviously, you got a drop, but people will say it was virus related. So the numbers that come out in 2021 and 2022 are going to be really interesting to see whether miners can get gold production back up, or whether we're starting to see a drop in production. As we know, gold is a finite asset. Okay, so looking ahead, what does all this mean? So these are some points here, really written by my chief market strategist. His first point is, can investment demand continue to be strong to offset that weak consumer demand this year? I think back to the market in 2009 to 2011 when you had fear in the West driving, ETF purchase of gold, but simultaneously you had a large amount of stimulus out of China that really spurred the physical market at the same time. So, his second question here is, can consumer demand recover before investment demand has quietened? That would be interesting for gold. The economy is obviously key. Are we seeing a W? Are we seeing a U? An L? The latest one I saw was a K. What is the shape of the recovery? And we can talk a bit more later, but we have a great tool on our website that I really recommend those who are interested in modeling gold and how gold might perform in different scenarios can take a look at, called Quorum. It's on the website, which is goldhub.com, which I'll show you that later. But it can help you can input your own, so you can input whatever you think US GDP is going to be, where you think interest rates are going to be, and it'll give you an idea as to how gold will perform in those different market conditions. So finally, on the kind of forward-looking element, I challenged my chief market strategist to, I said, look, you talk too much. Give me 3 things that are interesting that we should be watching for the rest of this year. And so he pulled out these ones. So one is real rates. We haven't really touched on real rates yet, but many of you who follow them will know real interest rates have been negative. And Powell has more or less explicitly said he wants inflation to run a bit hot. So with that in mind, and with the low interest rate environment that we're in, it's obviously a positive environment for gold, but it is worth keeping an eye on real rates. I think probably the biggest concern or worry for gold would be something like a credible vaccine coming out, and then economic activity very quickly getting into gear, and real rates moving, to adjust quite quickly to that. That would probably see a lot of the hot money come out of gold, and would be a concern for gold. But the correlation with real rates is one of the strongest correlations I've seen around gold. So you've got to watch real rates. Another thing to watch going forward would be ETF flows, and I think this is really a proxy for investor demand. We know, as we've said, investor demand has been very strong this year. Can it continue? So the second thing he'd be keeping an eye on would be ETF flows. Are they remaining strong? And they're still positive in September. I think that's something like the 10th month in a row for ETF flows. And then finally, the third thing you keep an eye on would be something linked to the physical market. Here, he's picked out the physical contract on the Shanghai Gold Exchange as a proxy as to whether he sees physical demand starting to pick up or not. Other things you might watch are things like the premium in China versus London, or the premium in India versus London. And so that's really a kind of outlook and a what we'd be watching in the future. I do want to draw your attention to goldhub.com for those who don't know it. This is a website that we put together, I mean, literally for you guys. It's for investors. On there, you can download, you can get hold of a lot of data, you can download it into Excel and have it on, use it, play with it, do what you want with it. There is research written by my team. I think I've got 8 analysts now, which is more resources than I had in any investment bank. And then there are tools on there too, such as Quorum that I mentioned, where you can go in and tinker with the model and put in your own inputs and run it to see how gold would perform. So there's a lot of stuff on this website that I highly recommend you look at. And here are our email addresses. Do reach out if you've got questions on gold to Estelle and myself, and we'd be very happy to help. So Devet, if you're there.
I'm here, yes. Jasper?
Right, yes. So I just wondered whether anyone had any questions or anything particular you wanted to discuss. I hope I've answered or some of the queries you might have had on gold today.
Yeah, thank you very much, Jasper. I think what we'll do is just give anybody an opportunity to ask their questions and have a bit of a Q&A session. So if there is anybody that has anything to ask, please go ahead. Okay, I think while we wait for anybody to formulate their questions, I have a couple of things that I would just kind of maybe check with you. What is your view on that, and if you can give us a sense of what's happening in particular, how does the super or endowments work elsewhere in the world when people want to contribute or hold a part of their portfolio inside of their pension fund? Can you give us a sense of how it works elsewhere?
I mean, so we're doing a lot of work, globally. Actually, probably started out of the US, and then spread into Europe, where I was working prior to here. and we're hoping to come into Asia and help people on this sort of subject. We were doing a lot of work with endowments, with pensions, helping them model gold, and helping them think about gold as something, particularly in a low interest rate environment where this asset liability matching is becoming more and more difficult. That it's pretty handy to have something in your portfolio that has the behavior kind of attributes that we mentioned earlier. So we've been talking with some actually very sophisticated investors who, sometimes it surprised me, the sort of questions that they ask, all things that we like to cover. Specifically, I've seen, I have to stay away from too much on the product side, but certainly there are some ways that you can add gold in that I've seen in the last from out of some of the superannuation schemes and the defined contribution schemes in Australia. The performance of gold has been around shy of 20%, I think, for a lot of these products. So it is something nice to have in a pension, and something that can help dampen your volatility overall, and be there as a bit of a life raft when things get a bit messy like they did in March.
Yeah. So what's the typical percentage that's invested into the gold within the EPF? I know you touched in your presentation what is sort of the recommended.
Yeah, we get asked that a lot, and there's no right, there is no kind of right answer, because it does depend what you own. If I don't know if you're aware of target date funds. It's another kind of pension product that's out there whereby you can, for example, for me, I would buy, for example, something like the 2050 target date fund, and then my money would go into this fairly passive product, and over time it would evolve to 2050, where I would retire and take, start to draw down on it, and it would be modeled perfectly over time to work for me on that basis. And on that basis, you'd want to have more equities if you're young and you've got a long time to retirement. And when you hold more equities and more risky assets, you want to have a bigger portion into gold. As time goes by and I get close to retirement, I'd expect my pension to start moving into more fixed income type assets. And with that in mind, you might want to reduce your holding to gold. Although, with the way that central banks are talking about stoking inflation, I'm not sure how much fixed income I really want to own. But in that, on that basis, you have a little bit less. And I think the slide I showed earlier, which was that sort of typical pension, US pension, that was a diversified pension, it would have had real estate in it, would have had foreign equities, US domiciled equities, emerging market equities, all that stuff. And for that portfolio, around 5% would improve the risk-adjusted returns, pretty well. So generally, it is a number around 4 to 5, but it really depends what you've got. We've seen up to 11.
Okay. So those examples that you've sort of quoted in terms of the returns in the region, you spoke about 20% recently. But I mean, isn't with most EPFs, if once it's inside of the EPF or a super fund, this is going to be a long-term investment, most likely. So I mean, how long do you see people holding these? I mean, they wouldn't be liquidated out of the EPF, I presume, easily, like the normal flow of gold in the market. So I mean, the long-term trend of gold has been quite good over the last 30 or 40 years. I think that even exceeds that outlier of 20% of last year. So do you tend to see people keeping it for a long time in the EPF, or is this sort of a recent development that the regulators start allowing people to hold the gold inside the super funds?
Specifically on super funds, I don't know the answer. In terms of the way that people are thinking about gold and holding gold, in the last year, and this is happening in Asia, by the way, as well as the other areas that I've been working in globally, we are starting to see less of this hot money, this kind of, I want to take 10% out of the market and get out, and more of these pension type investors who recognize that recognize what gold can do for them. They recognize that we're in some fairly unpredictable times, and that they need to start to perhaps spread their bets a bit wider and diversify their portfolios. And we've seen some big positions put on by some of these pension, fixed income type investors. Some who've had a mandate to hold gold, but really they hold fixed income, and in the last 12 months have decided actually this is a time to use that mandate, and some of them are now holding gold alongside their bonds. So it's those sorts of investors we don't expect to get out when the market gets a bit choppy, as it has recently. I definitely see them as longer term investors now.
And I mean, generally, there's I think I'm not. Obviously, it depends on the tax laws of the various countries, but I guess they should be. These are purchased with pre-tax money. Is that right or not? When it goes into your super fund?
Yeah, I mean, yeah. If you're buying a super, I would expect you to be paid the money gross, right? You'd avoid paying tax. So in that sense, you do get a you get a tax deferred benefit basically.
Yeah.
So you would be putting 100% of the money in, and then when it comes to withdrawal and crystallizing that pension in whichever year you do that, I'd expect you to pay tax down on it then, and that is a good way to accumulate returns, because you're using a gross number to do that.
Okay. So I guess your particular role for moving here in the region for the World Gold Council, can you just elucidate a little bit on that? Is it particularly to promote the uptake of gold in Asia, and can you give us some of I think you've already given us some examples of investors in the US and so on. What's the sense of that locally here in Asia?
Yeah, thanks. So look, I mean, as I said, I was locked up in a hotel for a couple of weeks for early September, so I've only just been let out. But my role alongside Estelle, who's joined us in August, is to get out, meet investors, help people think about gold and what attributes it has and what it can bring to their portfolio. I'm not out there just to say only own gold. I think there are a lot of other interesting assets that go alongside it, but I do think that having an allocation to it over the long term does bring benefits, and a lot of people just don't think about it like that. So we want to be working with asset managers, with pensions. You mentioned the superannuation funds, all these types of investors, really to help explain gold better, help them better understand it, and hopefully see more of these guys allocate to it. And certainly the way we're working is having successes in the States and in Europe. So it made sense for the CEO to start bringing that into Asia as well.
Yeah.
But I just add also that look, we don't charge anything. We're fully funded, independent of anyone we speak to. So we are literally there to help you. So do reach out. Thank you. So thank you everybody for joining.